businesses traverse through the VUCA world. VUCA is an acronym meaning volatile, uncertain, complex, and ambiguous. It was coined by Warren Bennis and Bert Manners. The U.S. Army War College later on brought the term to currency in order to navigate through the post-Cold War era. Businesses navigate through this VUCA world by way of a complex mechanism called the corporate risk hedging. Hi, I'm Nagendrapreet Singh. I'm a business and corporate lawyer based out of Delhi. And in this short video, we will be talking about the three ways businesses hedge their risks in order to avoid gloomy prognosis and to attract investors, talent, and lower rates. From the corporate legal standpoint, there are there's a three-pronged approach in hedging corporate risks. First is diversification, second is contracting protections, and third is financial instruments and insurance. We would take these one by one at a very high level, an eagle's eye view, if you will. The first one is diversification. The first method of risk hedging is diversification. Diversification could be in product or service offerings, operating geographies, or even production facilities. Diversifications could mean having diverse clients, vendors, or operations in multiple jurisdictions. A recent example would be Apple starting a new production facility in India, and that could be a way of offsetting the tariff issues between US and China. We also see outsourcing industry has its delivery facilities scattered between the Philippines and India, and that is for the purpose of having a business continuity in the event of political risks that this geography or that geography might pose. The second way of risk hedging is contracting protections. Strong contracts set clear limits on liability and secure payment terms. Indemnity clauses, which are often very ardently negotiated, are the tools of hedging future losses. Subcontracting is another example of passing on the risk to another entity. When we cap liabilities on all the contracts, we have a known number for total risk on that business. For example, if all the contracts cap liability at 100% and the total contract value of a company is $1 million, then we would know that the total liability risk on that company is $1 million. One could take this number to the insurance underwriters and buy a liability insurance then. If this number is not certain, then buying insurance would be very difficult. The third is the financial instruments and insurance. Once the contracts are in place, then the next step is to secure the performance of these contracts, which are hedged using financial instruments. These could be in the form of bonds and guarantees, etc. For example, you would have a performance bond or an advance payment guarantee or a parent company guarantee to ensure that the contracts are performed well. In the North American geography, you could also have sometimes something called a surety. A surety is kind of an underwriter which secures another vendor at whatever the price to perform the contract, which the original vendor could not perform at the cost of the original vendor. And finally, other financial instruments kick in. These are in form of derivatives and futures with options. Swaps are there. Credit insurance is another example of financial instrument that works for you. By combining all these methods, businesses manage to keep a low risk profile, securing lines of credit and capital at low rates, resulting in a steady growth in the VUCA world. On that note, once again, thank you very much for being with me. Let me have your thoughts and let's keep the conversation flowing. Thank you.